Welcome back to BloombergQuint Live. On this special discussion today, we've got Ray Farris, Chief Investment Officer, South Asia at Credit Suisse. He's joining us right now. Ray, thank you so much for taking out the time and speaking with us. Just want to get your sense on the overall mood for equity markets right now. Obviously, investment sentiments has hit troughs, but surprisingly, even though there is, while a few countries have reported, cases petering off, there's really no indication that this is going away anytime soon. The economic impact and the outlook projected by the IMF is a big deterrent to sentiment. But yet the equity markets are reacting in a completely different shape and form. We've got markets moving into bull territory already. Do you feel that this is running a little ahead of itself?
I think markets are responding to two key drivers. The first is that although there's still a lot of COVID infection out there, new case momentum has started to come down. It has at least peaked in Europe and the United States, and it really looks like it's beginning to moderate. So that set the stage for countries to reopen their economies. Germany's already begun to ease conditions a bit. There are going to be other countries that are going to follow suit. So that creates an outlook for economic activity to restore. I think the second factor is that policy support, both monetary and fiscal, has been both rapid and just unprecedented. So if we focus on the U.S. has pushed through over 10% of GDP worth of fiscal support for its economy, and it looks like it's going to expand that further in the coming days. Of course, the Fed actions have been massive. They've gone beyond what the Fed did in the global financial crisis, and they're having a very powerful effect stabilizing markets.
All of this, and add to that the current issues surrounding crude. It's been unprecedented, the kind of sell-off that we've seen in crude prices, and not just the issues with regards to the last month's series because of storage issues at Cushing, but the underlying demand itself has completely vanished from the system. And if at all you do need things to start looking slightly more positive, crude oil needs to stabilize and it needs to start moving up. Demand needs to start picking up. Until that happens, Ray, do you envisage any silver lining to this?
Well, that's generally right. I mean, the main problem for crude, the main problem for earnings for most companies across the board is that the policy prescription for managing the COVID infection has been a collapse in economic activity. And for crude oil in particular, that's involved, a virtual collapse in international travel and even domestic travel. So the core requirement, for there to be any sort of recovery is that we get some improvement in demand conditions, and that's that the virus begins to be brought under control in the major economies, allowing for a restoration of activity. That's already taking place in China. In many sectors, China has almost completely normalized. Travel activity in China is beginning to recover. We would expect in the West, in Europe and the United States, that we'd start to see reopening of economies in another 4 to 6 weeks. In some areas in Europe, even sooner. And that would allow some recovery in demand for travel, demand for energy-related products associated with that, which combined with the supply cuts that OPEC Plus has announced should stabilize prices, not in the next month or two. That's sort of too little too late on that time horizon, but going into the late third quarter and the fourth quarter of this year.
What's your assessment of what this demand destruction to crude prices will eventually do to the crude importers like India, for example? Yes, there is a benefit optically, but the demand for oil is anyways not as high right now for countries to make that net benefit in the first place.
That's roughly correct. But as countries come out of these lockdowns and industry and travel resume, we're still going to have low oil prices for at least the next couple of quarters. So, our forecast is for Brent crude to return to about $45 a barrel on a 12-month horizon. Over the next couple of quarters, almost all crude benchmarks are going to remain historically pretty low. So as countries such as India come out of these lockdowns, they're still going to benefit initially from low oil prices. One aspect of that will be that inflation pressure will remain very, very low, and that could translate into a greater capacity for lower interest rates. I would agree that we're not going to see these positive effects in the next couple of weeks. We've got to get the COVID infection under control first and get the economy returning to normal operations. But if we look out, say, a month or 2 months from now, there should be some benefits.
Ray, in your conversations that you guys must be having with corporates, is there a lot of plain chatter or actual thought towards distributing some of the supply chains out of China into the South Asian countries at large? Are you seeing palpable evidence of that, or is it just mere rhetoric?
I think that the trade war kicked off some pressure on companies to diversify their production lines. And there was a little bit of evidence that that was beginning to take place late last year and early this year. Right now, it's tough to know what's going on, simply because the global lockdowns, the hit to the global economy has, of course, stalled all sorts of business investment plans. My guess is that one of the lessons from the trade war and now this shock is that companies need to have production facilities that are more diversified and more resilient to these shocks. And that's probably going to entail some spread of supply lines away from China rather than the degree of concentration that we've seen, over the past decade.
Ray, what's your outlook on India as an investment thesis, India as an investment market, and a call on the currency as well now? Do you anticipate dollar to continue to be king of all investments for at least the foreseeable future?
Well, a lot of the fall in emerging market currencies that's taken place in the last month or two was driven by this dollar funding shortage that emerged in March as companies really saw a collapse in revenues and had to begin tapping banks for credit lines. The U.S. Federal Reserve has worked very hard, and I would argue fairly successfully, to calm that storm and inject substantial amounts of dollar liquidity into the global economy. With that, the dollar has gone from strengthening substantially to really sort of stabilizing to a great extent in a general sense, across the board. It's bouncing around, but it's certainly not trending anymore. Our bias is to think that as the economy normalize, as COVID outbreaks come under control, that the dollar will probably soften somewhat against the major currencies. And the history of emerging market currencies is they tend to weaken, or I should say they tend to strengthen against the dollar when the dollar weakens against the major currencies. India is a particular case right now simply because it probably still has a small current account deficit. Even if the current account balance has managed to swing into a small surplus because of the collapse in import demand, India has been experiencing outflows of foreign investment both in equities and in bonds. My guess is that that can continue for a little while longer until markets have a better sense of the state of the COVID outbreak in India. As that COVID outbreak comes under control, we'll probably see a cessation of these portfolio outflows, some degree of money going back into India, and the currency stabilizing. That's our outlook for the currency. We're relatively neutral on most Indian assets, in part because of the uncertainties associated with the COVID outbreak.
All right. So within the South, in a South Asian region, which is the most favorite market of yours right now? I mean, what's your pecking order?
Well, at a global level, we're overweight equities. It's a small overweight position, but we tend to focus that on developed markets, particularly Switzerland and the UK. Within Asia, we're neutral across most markets in equities, and we are slightly underweight Malaysia for a variety of reasons, one of which is the low oil price. Within ASEAN, we think it's tough to find anything that really stands out as yet being in a position to see a big recovery and lots of return portfolio flow. So our position is really neutral right across the region.
Ray, thank you so much for joining us. Really appreciate you taking out the time.
Thanks for having me.
Well, that was Ray Farris there of Credit Suisse. That's all we have here on this broadcast. Thank you so much for watching, to all our viewers as well.